Well, a host of US data releases surprised to the upside last week, leading to a modest hawkish repricing in terms of Fed policy expectations, which in turn posed a modest headwind to stocks, which snapped a 3-week winning run, while treasuries sold off and the dollar also gained some ground. This week, focus turns firstly to end of month and end of quarter rebalancing flows. How on earth are we already 9 months through 2025? Before we then look ahead to the jobs report, the September labour market data on Friday, though the looming risk of a government shutdown in the United States will certainly keep participants on their toes. Plenty for us to discuss on the trade-off this week. Without further ado, let's get on with the show. So it was a bit of a choppy and uncertain and nervy week for financial markets last week, which, speaking as an Arsenal fan and an ardent supporter of Team Europe in the Ryder Cup, really sums up my weekend as well, although all's well that ends well. Joining me, as always, to try and make sense of everything that's going on in the financial markets and to offer some golf tips if he wants to, is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, very good afternoon to you, mate. I suppose you're on top of the world. Graham Potter's out. You've got a new manager in. The only way is up for West Ham, surely.
Oh, of course, the only way is always up for West Ham. I mean, you can't get any more down the bottom than we are. So yeah, it's only one direction we can travel in. But as for golf tips, I don't know. Is that another little challenge you want to take part in, a little golf game or something?
No, I think with my back, it's probably best if I stay firmly sat down behind this desk. But I will remind you, Ryan, that the only way is not necessarily up. There are, many levels of that footballing pyramid below the Premier League that you may find out exist sooner than you'd hope.
Yeah, that's true. I've been down there for a couple of them as well. So yeah, I know what it's all about.
Right. Well, before we depress you too much, let's crack on with Topical Thunder. Right then, so the payrolls numbers, of course, it's the first Friday of the month coming up, which means we should be getting the September US labour market report at the end of the week. But the bigger question this time out is not what the data is going to tell us, it's whether we're going to get the data at all. As I mentioned in the intro to the show, the US, as of the time of recording anyway, looks set for a government shutdown. Federal funding will expire at the end of September, so midnight Eastern time in the very, very early hours of Wednesday morning. And if that happens, it is highly likely that not only the jobs report, but also other economic data, such as the jobless claims data, essentially anything that the federal agencies collect and disseminate, that is all likely to be delayed until funding is restored. Now, assuming that the data isn't postponed and there is some sort of miracle, which means federal funding continues, headline non-farm payrolls are set to have risen by about 50,000 in the month of September, which would be a decent rebound from the 22,000 that we saw in August, and also probably in line with where the break-even pace lies at this moment in time, at least if we go from what Fed Chair Powell and other FOMC members have been saying. Unemployment, meanwhile, that's expected to have held steady at 4.3%, although, and I'm including this just for Ryan's benefit because I know he loves this sort of thing, the unrounded unemployment rate, that was at 4.3237% last time out. So the bar for that to round up to 4.4% in a new cycle high is not an especially high one, while participation, that should remain unchanged at 62.3%. Just a tenth above the cycle lows that we saw during the summer. And earnings pressures, just in the interest of good order, should be relatively contained, unchanged at 0.3% on the month and at 3.7% on the year. Now, of course, the Fed's reaction function at this moment in time hinges pretty much entirely on what's going on in the labour market, given that they are looking through tariff-induced inflation as a one-time shift in the price level, and certainly after the core PCE data came in bang in line with expectations on Friday. So I think really regardless of what the jobs report shows on Friday, the base case will remain that they deliver 25 basis point insurance or risk management cuts in both October and December. And I think, frankly, a sort of delay to the data is unlikely to matter too much in and of itself, given that, and I know we were discussing this in your room last week, there's enough private sector data that we will still be getting. Think things like the ISM surveys, the ADP numbers, the Challenger Gray layoffs data, data that will help you to build a picture of how the jobs market is looking. And of course, if we do go into a shutdown, then the market is going to be much more sensitive to those releases than we might typically expect it to be. But overall, the Fed strategy is still to run it hot, is still to lean in and support the labour market. And at a time when the economy already looks pretty resilient anyway, in my mind, that leaves the overall backdrop as still bullish in terms of risk and still bullish in terms of the dollar as well.
I can't believe you've just said that ADP data is going to be important. I mean, I know a certain other Ryan who's going to be happy with that comment coming up. I'll make sure he knows about that.
I'm sure you will.
Yeah, but
mainly in the absence of anything else. I mean, I'm not saying it's actually of any use on its own. Don't get carried away.
All right, yeah, go on, give all the excuses you like. Yeah, I mean, this is something I looked into last week, and actually when we had the last shutdown, 2018, 2019, we did get the jobs data because the BLS and those departments continue to get funding. So it's not definitive whether we get the jobs data or not, even if we do get a shutdown, but we're going to have to wait and see for that. And just if we do get the data, on top of that, we've got the potential mess of all those government layoffs dropping into these numbers. September was sort of the time when apparently, oh, here he goes.
That should emphasize that, be in the October report, because those who took deferred layoffs should still be paid until the 30th of the month, which means they'd still be counted as employed. That's my understanding of it anyway.
Yeah, well, I was going to say that it's the sort of the start of the period where we may start to see those coming through. So it just makes the whole thing, even more of a mess. And if we don't get the data, and we're not going to know how many of those jobs, any of those government job losses are coming through, that's just going to create a big whole mess later on. So one way or another, we're going to get these jobs data. It's either going to be good, it's going to be bad, or there's going to be some skews in the middle. I mean, more importantly, I don't know what I'm going to do with the NFP competition this week. Do I do it? Do I wait till Wednesday? You're going to wait until the 11th hour, 59th minute, 59th second to make your guess anyway. But yeah, it might be a late competition this month.
Well, I was just about to ask about that. I mean, has your funding expired and someone needs to go and renew it somehow in the form of a brown envelope or a bag full of used notes or something?
No, we have none of that here. It's an above-board competition that's run to the simplest rules you could follow. It's a shame some people here can't follow them.
Yeah, if KPMG or anyone are listening, then give me a call, please. Anyway, moving on to geopolitical developments, which have flared up a little bit over the last couple of weeks.
Yeah, we're seeing a bit of a step up in this sort of war of words going on. It's a subject we've spoken about before when headlines sort of come to the fore in markets' minds, and we've entered yet another dangerous phase here. Back in August, we had that Trump-Putin meeting, which ended with lots of platitudes, but nothing concrete, nothing of substance. There was hope for a potential ceasefire, maybe something more. Trump gave his usual deadlines. They passed, and now Putin has absolutely shown no signs of or any interest in making peace. He's even now openly baiting the West with these airspace incursions, even more than usual, which last week brought a pretty strong response from NATO, saying that NATO's countries could be justified in shooting down Russian aircraft that enters into their airspaces. Trump also gave a bit of a green light to that too, adding with a bit of a caveat that they can do that depending on the circumstances. It almost looked like he sort of washed his hands of it last week, saying good luck to both countries. But we've also, over the weekend, we've had a couple of members from US administration speaking, particularly Special Envoy Kellogg of the Ukraine Special Envoy. He's proclaimed that Trump's given Zelensky permission to use long-range missiles to strike into Russia, although that is conditional on specific instances authorized by the US. So there's still a bit of a leash on that. Zelensky, in the meanwhile, he's asked to be supplied with Tomahawk missiles, so he's definitely looking towards some further strikes. Now, we got European countries potentially looking to take a harder line, a more military line, perhaps with Putin, and this possible step up in what Ukraine might use to hit Russia. Markets are once again paying attention to these headlines. And, if we do get something like NATO, any country shooting down a Russian aircraft, that's going to be a big headline that hits the market. So I think unfortunately, we've moved past the often ignored sanctions warnings and all that rubbish that they've been trying to throw at Russia. Now we get into something far more serious. And I think traders need to perhaps consider their positions, risk positions, if you want to run something over the weekend, because if you get hit by a big headline, we could see some big gaps on a Monday open. So there's nothing wrong with closing your positions on a Friday night and reinstating them if nothing's happened on a Monday. But we're in this step up, and you've got to be aware of it.
Yeah, I think that's very sage advice. Although it's interesting, we actually saw risk rally into the close on Friday as opposed to any sign of folk trimming off their positions. I'm really not entirely sure where we stand with this one. I mean, it feels like one of those that markets are just going to ignore until they don't ignore it anymore, which I appreciate is probably the most useless bit of information I've ever given on this show. But what I mean by that is, well, yeah, I was going to say there's a lot of contenders. What I mean by that is, we get these headlines every day of incursion here, drone here, fighter jet scrambled there, and it's all noise. And then, as you say, there's just that risk that one day one of those headlines is jet shot down, at which point it's suddenly a very, very big market story, and arguably a story that probably no one is really hedging for, because it's a difficult risk to hedge, and also quite an expensive risk to hedge as well when the market's just relentlessly moving to the upside. So yeah, I think it's important to be nimble. It's important to be agile. Be very, very on top of the headlines as and when they break. What I would also say is, I think if we were to get any knee-jerk risk aversion on the back of an escalation in tensions, then I would say that's a dip in the equity space that I would be looking to buy into. It's very rare that we would see a sustained decline on the back of geopolitical flashpoints. The way these things tend to work is big spike in gold, big spike in crude, big spike lower in risk, and then within 48, 72 hours or so, if not a little bit longer, you're generally straight back where you started as that initial fear fades and sort of calmer heads begin to prevail, not only in terms of markets, but also the various actors involved in those conflicts. So I think it's very much a risk to be aware of, but unfortunately, it's also a risk that unless you can play it through options, even though, again, they're probably a pretty expensive way of doing it, it's also quite a tough risk to manage and lessen until it actually happens.
Yeah, I mean, I probably wouldn't go rushing in to buy a dip if you get a headline that a Russian plane's been shot down, because you're probably going to get a very, very big reaction, because this will be the first direct conflict that NATO's entered into with Russia, for probably since I can't remember, and that will be a real big step up, because it's not now. The West has been sort of holding back a bit, even the munitions they've been giving Ukraine. You can use it for this, you can't use it for that. But if Poland shoots down a Russian aircraft, it's the proverbial poop will hit the fan. And I'd want to let that ride out for a little bit before I think about buying any dips.
Right. Well, we'll let you go and continue your warmongering somewhere else. I am now instead going to talk about the Eurozone, because we had some decent figures out of the Eurozone last week, although I'm going to caveat that by saying that they are PMI surveys, which means that we do need to take them with a little bit of a pinch of salt, given that what we've seen this cycle is very much the sentiment data overstating the extent of any economic resilience, but also overstating the extent of any downside. So, maybe the PMIs aren't the reliable indicator that they have been in the past. In any case, we did see the flash services metric rise to a 9-month high of 51.4 in September, while the composite output metric, that rose to 51.2, which is a 16-month high. So potentially some tentative signs that growth may be starting to turn a corner, and certainly, of course, comes after ECB President Lagarde said at the September press conference that growth risks are no longer tilted to the downside. So even if things aren't necessarily getting better, certainly those PMI data don't point to any further momentum being lost that could signal the need for the ECB to do anything. At the same time, this week, focus is going to turn to inflation. Flash inflation in September, CPI, that's expected at 2.2%, up for a prior 2%, or the core metric, that's seen having held steady at 2.3%. Again, very little there that would signal the ECB needing to do anything more in terms of further easing to provide a bit of stimulus to the Eurozone economy. At least not with them continuing to forecast an inflation undershoot in both the next 2 years, according to the latest staff projections. Add on top of that, the euro has come off a little bit. Euro dollar was back under 117 last week. The ECB's trade-weighted euro index is off its recent highs as well. And if you haven't worked out where this is going yet, then I'll tell you. All of this really supports my view that the ECB are done and dusted. As President Lagarde has said, policy is still in a good place. And speaking of good places, Ryan, I hope you're going to find a good place to take me to lunch when I win that bet of ours.
Well, there's a long way to go before the end of next year, mate. So
only because you've changed the rules.
Oh, here we go again. The sour grapes are coming out. That's what I'm going to buy you for lunch, sour grapes.
I've got enough of them.
Yeah. I hope you choke on them. But there you go. It's already choking on them. Brilliant. That's another prediction one. Right. So, yeah. I mean, I've a slightly different thought with these PMIs. Yes, we've seen a broad improvement with the pan Eurozone number. That was largely looking like Germany, who had a bit of a jump up in their services metric. Other countries like France are looking to go backwards. Even manufacturing, everyone was creeping towards that 50 line, that expansionary line, and they all went backwards as well. So I don't think Europe's out the woods any way, shape, or form. But yeah, I think we're in this period now where inflation, we've coming off a big inflation hit. We're coming down to some sort of normality, shall we say, and we're going to see gyrations above, below. But that inflation impact wasn't due to economical factors per se. That was a big shock. So now we get into the economies, how they filter through into inflation, and the Eurozone hasn't got a strong economy, and that's not something that should bring inflation along with it. So yeah, I'm still in the mindset that if European economies remain weak, countries such as France are already doing that in the PMIs, firms cutting pricing to encourage that business, then I think we're going to see further weakness in inflation, and as per my calculations, taking ECB down in rates a bit more.
Well, there we are, ladies and gentlemen. Ryan Littlestone with a perfect example of how to spend 2 minutes talking your own book. And why not? Because no one else is going to talk your book for you. Speaking of books, rebalancing those books. Every time I bring this up, I always get heckled about rebalancing flows. But Ryan, I'm going to let you off. Take it away.
Oh, thank you very much. I think I do this every quarter anyway, so it's not. I'll have to check back on the prior videos. But yes, we have got end of month and it's end of quarter two. It's that time of year again when we can see some spicy moves due to these month-end flows. Now, when we get a month in that's also a quarter end, those flows can tend to be a little bit bigger. And this month, all the bank models are pretty much pointing to some heavy US dollar selling this month, with varying signals over what that's going to be against. Excuse me. So while we don't know the exact specifics of what they need to do and what firms are going to be doing, one does need to be watching the clock pretty much at the top of every hour, particularly through European session, as that's when we can see some of those flows being pushed through. So if you suddenly see a 10, 20 pip move, in a currency, and that happens sort of 10 minutes before the top of an hour, and if there's no headlines to back that up, then it's likely we're seeing some of those end of month flows. Now, the main fix is the London fix, 1600 British Standard Time, and that's where we can see the bulk of these moves, and that often happens in two phases. We can start to see moves happening anytime for around 30 minutes before the fix, and then the actual fix moves happening over a sort of 2-minute window, plus or minus the top of that hour at 4 o'clock. Now, the problem with these flows is that they can, give us a false picture of what the market's doing, particularly when they happen for a few days on end. So the best way to trade it is to know how the market is positioned for the fundamentals and what it was doing before we hit this period, and then see if these flows push the market out of sync with that. So if you think the dollar, for instance, is in recovery mode following the Fed, any end of month selling might be an opportunity to grab a dip if nothing's changed in the underlying fundamentals. Now, that's something I'm potentially looking for in dollar yen, where it's just failed on another topside range breakout attempt. I know Westy had this on, I think, on his play of the day last week, a break of the range 148, 80s, 90s. Who's that Westy bloke? Oh, it's them lot on the other side. Yeah.
Oh, the beater.
Yeah, him and
Yeah,
Blake.
yeah.
Yeah, every so often they talk a bit of sense, so you've got to give them credit where credit's due.
Well, even a broken clock.
Okay, before we get into a fight with them lot,
Yeah.
yeah, he was speaking about this range break. We had that attempt. So I think if we do see some further downside in dollar yen that I suspect is end of month related, I'm perhaps going to be looking to pick that up.
Well, very good. The other thing with the yen, of course, is moving into the weekend, the LDP leadership vote. I have absolutely no idea who the front runner is for that because I've completely forgotten all the names of everyone that's involved with it. But go on.
It's Takaichi is in the lead. Excuse me. And that's we actually had an important poll out overnight from LDP members. So they're the ones who are actually going to be making a decision, and they had her in front. So it looks like it's potentially going to be her anyway.
Well, there we go. Thank you, Ryan. Clearly something I wasn't paying attention to when I should have been. But that is, well, that's not uncommon. But that is also a big risk to watch in terms of the yen if you do have any positions over the weekend, in addition to all of the geopolitical stuff we mentioned earlier. And yeah, I think in terms of the end of month, end of quarter fixing type moves, there's really two things you can do. Either when that move starts off, you can try and ride that momentum into the fixing, but also be prepared that if we are seeing moves that are supported more by fixing flows than anything fundamental, then they are liable to reverse in relatively rapid fashion after that fixing window has closed, which if you're a short-term trader, at least gives you the opportunity to trade that on the way back down as well. And as you say, if you're taking more of a longer-term view, then it can provide potentially more attractive entry points. And yeah, if you look at the dollar, which has rolled over against pretty much everything today, that's certainly a dip in the greenback that I'd be looking to buy, given how risks the outlook there pretty much tilt to the upside in my mind now.
Yeah, and if you're a financial commentator and you don't understand what's going on, just blame it on end of month flows.
Oh, there's no need now, mate. Everything's being blamed on the government shutdown this week. Apparently, gold's rallied for 8 weeks in a row, but now it's all because of the shutdown. Kyriakos, roll the titles before I swear. Every presenter needs a producer who's got their back. What a top lad he is. Right, our plays of the day this week. I'm going to be looking at the dollar. I mentioned a moment ago how risks to the outlook in the US now tilt to the upside. Well, you wouldn't really know that from looking at the dollar. It has been the greenback's worst start to the year in over 3 decades. If you look at the dollar index, actually going all the way back to 1972, which was just after the gold standard was forgotten about. But, and also just when Ryan started in financial markets as well. Looking,
I was born in 1972. You cheeky sod.
Did you say born or bald?
Well, both.
That's completely thrown me now. Where on earth was I? The dollar, battered and bruised, tide might be turning. Why might the tide be turning? Well, the Fed, they want to run it hot. That is leaning in heavily to support the labour market and to support growth, which is tilting risks to the upside in terms of the economic growth outlook. And of course, the Fed upgraded their own GDP growth projections at the September meeting. I was going to say all of the trade stuff seems to have calmed down, but just as we recorded this, Trump's thrown a 100% tariff on film imports. So maybe I won't mention that. But nonetheless, we are seeing stocks on Wall Street quite considerably outperform their global peers. You look at Europe, the DAX, for example, has gone nowhere for a few months now, while the S&P has rallied relentlessly. So some capital inflows probably stemming from that. And then as you start to look forward into the last few months of the year and also into 2026, you've got the fiscal loosening coming from the One Big Beautiful Bill Act, which will start to make itself known. And also potentially the Trump administration seeking to juice the economy further as we look in towards the midterms this time next year. All in all, it looks like an outlook where excuses to sell the greenback are kind of drying up and excuses to buy the greenback are beginning to mount up. And I think that means that the dollar is due for a bit of a rebound. We ended last week north of the 50-day moving average. If we can break above the 100-day moving average at 98.40, then you'd be looking to the top of the recent range at 99.20, and then maybe even a move back towards the 100 figure. Now that I've staggered my way through that, we can move on to the 10-year Treasury.
A bit like Arteta through the match yesterday.
Oh,
yeah.
No, I haven't been running up and down the touchline. Don't worry.
Yeah, he's got better hair than both of us, that guy. Anyway, I'm gonna get into 10-year treasuries, because one thing that stood out over the Fed was that 10-year yields held really strongly at the 4% level when the dollar was getting sold off, and that bottom was also the bottom for the dollar. Now, regular viewers will know I always say you should keep an eye on yields, particularly these yields, especially when trading the dollar over big events. And what we saw there is a reason why. So these yields are reacting very strongly to the ranges and the levels in play. The new range of which is now confirmed at 4%, between 4% and 420, because we had a rejection there on Friday at the 420 level. So with this big week of data coming up, I'm looking to play that range either directly through trading bond in price or via the dollar, using these yields to determine how far any dollar moves might go, when they might turn around or even just halt altogether. So 10-year treasuries for me this week, please, mate.
Very good. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, for bringing things together as brilliantly as always and bailing us out where necessary. Hopefully you've enjoyed the show. If you have, do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets or if there's anything you'd like us to discuss next week. And that is when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead and see you then. Thanks as always. Goodbye for now.